Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of 360 Money Matters. I'm Billy and joined by my co-host,
Andrew. Bill's back again for another podcast. Another exciting one.
Always back again, Andrew. Always an exciting one from our perspective. And we've got something juicy for our listeners and probably quite timing just in terms of what's happening in the investment market. Andrew, lead us in. What are we talking about today?
Yeah, today we're talking all about a topic that's a little bit overlooked, but equally, and if not more important than anything, what we're talking about is how to control your emotions and your responses to those emotions while you're investing. Bit of a change of pace. We're usually talking about investment strategies. We're usually talking about things that are a little bit more technical in nature, but today we're turning into psychologists.
It's funny you should mention it, Andrew, because you could put together, and we've seen it time and time again, but you can put together the best and most well-rounded investment strategy for a client. And unless somebody sticks to the investment strategy, then it's really a moot point, right? This is almost as critically as important as, receiving advice and putting together a robust strategy, sticking to it and being able to hold, I guess, not only just your nerve, but being able to stick to whatever strategy that you've put down, almost regardless of what the investment markets are doing, are just as important as where you're placing your money.
Yeah, absolutely. I mean, we've seen it all too often. And I'm sure that, if you haven't experienced it personally, I'm sure that you've heard about someone or seen someone that's bought in, markets dropped, they've panicked, sold, and all of a sudden you've made a huge loss and then everything's picked back up again, returned to normal. And you're like, oh, why did I sell while everything was down?
What do they say? Buy high, sell low.
Yep.
That's the emotional roller coaster that you generally tend to go through. As markets are rallying, you're starting to see things, you get euphoric, you get excited, you invest some money, and then they start to turn and you start to freak out and you sell at the wrong time. So you're almost doing the wrong thing at the wrong time.
Yeah, exactly right. And sort of irrespective on what you're investing in and irrespective on what the strategy is, making sure that you can, hold your nerve, making sure that you're making decisions based on rationality rather than emotion. It's so important. It's so important.
Throwing back to our main man, Warren Buffett, because we always...
we love to throw back to Warren, don't we?
We always love a Warren Buffett quote. Now, hopefully I don't butcher this and I managed to get it out in one go. One of his most famous sayings is be greedy when others are fearful and be fearful when others are greedy. So trying to put that in a really succinct sentence in terms of what we're talking about buying high and selling low. He's basically saying do the complete opposite of that. And I think that rings true as a broad brush statement in terms of the message that we're trying to get across.
Yeah, absolutely. So tell us, Bills, I mean, it's all good and well to start talking about, control your emotions, buy at a low and sell at a high and all of that stuff. But what are some practical things that our listeners can take out of this podcast? What are some of the practical steps that people can say, okay, this is what I'm going to do and this is how I'm going to do it?
I think the first thing is have an investment strategy. So it's really easy. And I guess in today's environment, it's probably the easiest that it's ever been. But there's so many different technology platforms, apps, websites that you can invest money through. So access to investments has probably never been this easy. So before you jump in, it takes a bit of discipline. You need to do a bit of research first and foremost. But before you jump in and start investing your money, I think from a really simplistic perspective, have an investment strategy. And it doesn't necessarily need to be anything fancy if you're just starting out, although we always encourage people to get advice because if you get this right, it'll absolutely change your life from a wealth creation perspective. But have an investment strategy. So understand how much you're prepared to commit, what your appetite is to risk, what your time frame is, and then there's a bit of an education piece around the actual underlying investments that you're investing in. So if you go into it and you have an understanding or a concept and almost like a personal contract with yourself, if you understand what's going to happen, market volatility, things are going to go up, things are going to go down, it's a lot easier to hold your position and maintain your investment strategy when things aren't always going the way that you expect. So I think that's probably the first thing that I'd be considering and talking to people about is what's your investment strategy and how do we build that up so you can write out the times when you're not feeling great about what's happening in the market, you're looking at your investment potentially, being quite volatile day in, day out. That's where I'd start.
So make sure that you've got a strategy, you've got a plan, you know what you're doing, you know why you're doing it, and you've got a time frame as to when you're doing it for. I mean, we see it all too often. People just want to put, $500 towards a particular stock. Okay, that's great and that's fantastic. And, we're always going to be proponents of investing and people putting money towards wealth creation. But what's the purpose behind it? What are you trying to do? And that's not to say that, you can't do something like that, provided that it forms part of your investment strategy. You're investing on a regular basis towards a certain portfolio, and then you've also got money set aside for market opportunities. So that can form part of the strategy, but make sure you've got a strategy and an understanding of what you're doing, why you're doing it, when you're going to do it, which kind of leads us into the next point. Depending on the strategy and depending whether this is your strategy, but one thing that can be incredibly powerful, not only from a mindset side of things, but even from an investment side of things, is investing on a regular basis and just direct debiting your funds towards investment. So you don't need to think about it. You don't need to look at, okay, where's the market today versus last week versus last month versus, last 6 months. You just invest on, whether that's a weekly basis, a fortnightly basis, a monthly basis. In particular for, young wealth accumulators, it's so powerful in terms of just taking your emotion out of the decision-making process. Because sitting on the sidelines, waiting for the perfect opportunity, waiting for the market to come down, very rarely, do those opportunities present themselves. So if you're just constantly investing on a regular basis and dollar cost averaging on the way down, if the market isn't performing, you're removing the emotion and you're just making it an automated process.
Yeah, really well summarized, Andrew. That's a really powerful strategy. And there's probably two things that I like about that. The first is it's the automation of it, as in you don't need to think about it. So if you pick an amount and you know it's going to come out of your bank account on the 15th of each month, you don't have to sit there and, not to the extent where you don't have to worry about the cash flow, but you know that it's already allocated. So it's done and dusted. You don't have to say, okay, today I'm going to invest money. Geez, where am I going to get that money from? That's the first thing that I like about it, because it is automatic and it gets you into that discipline around investing regularly, which then throws you to a longer term time frame, which we'll get onto that in a sec about, the investment time frame and the investment horizon. The second part of that is if you're doing it on the same date of each month, which is usually when a regular investment plan is set up, it's usually on the same date of a month or a fortnight or a week, whatever that may be. You're taking that decision-making process out of your hands around looking at the underlying investments and going, geez, that share or that managed fund or that asset that I'm going to buy looks high today or it looks low today. You don't have to go through that process. And once again, because the truth is picking the high point, picking the low point, geez, if we could do it, we'd all be, multi-billionaires.
We'd all be in the Bahamas on the beach, not sitting in our recording studio, recording a podcast. We'd be recording it in a different location. Still a pleasure, but in a different location.
In Melbourne today, the weather is 14 degrees and overcast. So we'd definitely be sitting somewhere where it's sunny, not in Melbourne. But they're probably the two things that I like about the regular investment plan. And if you can set it up on direct debit, so you can set and forget, you do get the benefit of dollar cost averaging over the time frame as well.
And I guess, look, the other point is, and it's all about mindset when you're going into it, expect that there are going to be losses. I mean, irrespective in, virtually any asset class that you're investing in, there is the possibility that losses will occur, that you're going to lose money at some point in time. And that just needs to be accepted as that's part of the game. Me and Billy have spoken at length in the past of, unless you're at a certain income level and a certain wealth level, you don't have a choice. You have to invest. If you want to, reach a particular goal in terms of retirement income, if you want to, reach anything beyond a more, modest lifestyle, then
wealth creation.
Yeah, just any sort of wealth creation, you have to invest, so you don't really have a choice. Getting into it and knowing that, okay, well, I have to invest in order to be able to achieve my wealth creation. Along that journey, there's going to be losses. There's going to be some things that don't perform the way that you expected. The market's going to turn at some points in time, and you just need to go into it with a mindset of, yes, that's going to happen. However, over a long enough period of time, over a long wealth creation journey, which is what it is, that will balance out and the market will come back and things will recover and things will normalize. So expect the fact that, losses will occur, and that's just an everyday part of investing.
Well said, Andrew. I think that also ties into, and once again, it's really dependent on where you're at from a lifestyle perspective, but even you consider somebody who is investing to generate retirement income, you still need to be invested almost regardless of your age, because you need to generate a return on your money. And it's even more prudent now because we're entering into a period with increased inflation. So the purchasing power of your dollar is actually getting less and less. But looking at your investments from a long-term horizon, and I think that then throws back to the original point around the investment strategy, that if you are investing for the long term, it makes it it's not great, but it makes it easier to digest the fact that markets do go up and do go down. Because if they do go down, and you're in a position that you're investing for the long term, that's just part and parcel along the journey that you're taking. So I definitely think longer term is the way to go. If you're investing in growth assets, equity markets, locally, internationally, your time frame for investing in those probably should be something for the longer term anyway, just based on a particular growth profile. But putting some of the things into context around expecting losses, being comfortable with it, having an investment strategy, if you look at these things with a longer term time frame, I think that makes that whole process a hell of a lot easier to not only digest and feel comfortable with, but the crucial part is with our message is to stick to it. And I think that's really the point.
Yeah. And look, when you're talking about making a long-term decision, trying to figure out what a particular asset is going to do in, a week's time or a month's time, that's an incredibly, difficult endeavor. And yeah, there's some people that, high frequency traders that can make a significant amount of money by doing, short-term investments and making small wins and all of that stuff. But the regular investor, trying to predict where the market's going to be in a year's time or 2 years' time, you're going to have far more success in investing on a longer term basis rather than trying to make little short wins and, continually do that and do that consistently as well.
It's easy to get caught up in the ups and downs of the market, no doubt about it. And that's probably a good one to sort of pivot into, Andrew, is blocking out the noise. Not only is today probably the best time or the easiest time in history to be able to get access to investment markets, and technology has made that process quite easy for us. But I guess the other side of the coin's true, where the flow and the speed and the availability of information has never been as great as what it has been today. So hearing the noise, and that's making people nervous, that then leads to making irrational and the wrong decisions from an investment perspective, is very real. So you can get caught up in a whole heap of stuff. You can get swept away with it. And if you don't block out the noise, honestly, I think you'd be paralyzed by all of this stuff and you wouldn't be able to make a decision, or, maybe you freeze, which probably is not a bad thing. So holding tight, we'll talk about that in a sec. But the other side of the coin is also true, where you may just be jumping at not necessarily shadows, but every time you're receiving a new bit of information, that may then influence the decision that you make. And then that will you'll deviate away from your investment strategy, which is probably the worst thing that you can possibly do. I know it's difficult, but blocking out the noise is being probably one of the most critical and important investment lessons that I've learned. And look, you get tested all the time. I mean, you look back in our most recent history, COVID, when it first hit, that tumbled markets 30, 35%. And that happened really, really quickly. Okay, the world didn't know what was happening, at that point in time. An example before that, the ship in the Suez Canal got stuck and disrupted global supply chains. There's that. More closer to home, or not closer to home, but more so in terms of what's happening now. It's the war in Russia and Ukraine. There's always something going on. So being able to take a longer term view, get an understanding of the real impact that that's having on investment markets all around the world, and blocking out that noise as best as you can is always a worthwhile strategy as well.
Yeah, well summarized. And look, as you said, there's never been more available information as what there is today. Now it's not about finding the information and gathering the information. It's what information is relevant in my decision-making process. As you were sort of alluding to, kind of struggle with this as well, because eventually someone's going to be right. But if you listen to the doomsayers, and there is never any shortage of them. So there's always going to be someone that says you shouldn't invest in this particular asset because it's about to crash and it's going to be a buying opportunity. But if you're constantly listening to doomsayers, if you're constantly listening to the market is going to crash, yeah, I'm sure eventually that's going to be right. But there's never any shortage of that mentality. And so if you do that, and if you're constantly waiting for the opportunity, the realistic point of view is that you're probably never going to act. And so making sure that you can just block that noise out, making sure that, before you embark on an investment decision, or even after you've embarked on an investment decision, that you just continue with it, continue with your strategy. And that's not to say that you don't adapt and change your strategy over time, but making sure that when you're doing so because it's a rational reason, because there's a purpose behind it, and not out of fear and not out of emotion and not out of, listening to, all of the noise that's happening around you, because there's so much going on. And it feels like, I don't know whether it's just the fact that we're in this industry and so the people that you surround yourself with talk about it, but I feel like over the last sort of 10, 15, 20 years, investments and markets is something that's on, pretty much everyone's tip of their tongue. Everyone's talking about it and everyone's discussing those things. Whereas maybe 20 years ago, when information wasn't as readily available, that topic of conversation wasn't always there. And that, rhetoric and that constant noise and chatter about markets was, a little bit more in the background. So it was a little bit easier to block the noise out previously.
There's definitely a greater awareness around finances, investing, wealth creation. I think that's just part and parcel of where we are at as a society. Maybe that's got to do with, longer life expectancy. So people realize that, you do finish working at a particular point in time and you've got decades of life that you need to fund from an income perspective. Whether it's the employment market has changed and you're not with the one employer for your entire career, you may have a whole range of different employers or different industries that you work in, but there's definitely a greater awareness around it, which is great because it means that more people are getting an understanding of this, are getting educated and actually participating in their own wealth creation journey, which is fantastic. And you alluded to it right at the start, Andrew. If you want to grow your wealth, if you want to do better, if you want to secure yourself financially, you've got to invest and you've got to be part of, you don't have to, but for the majority, you've got to be part of the investment landscape in order to grow your wealth. That's just the way that it is. And you have to go along with the movement of the market. And that probably pivots us into our next point, which has been really interesting of late, especially for some of our younger investors as well, is having a reasonable expectation around investment returns and the way that the investment markets are going to behave. We've seen of late certain asset classes, and there's probably two things that jump to mind. The first thing is you have a look at the cryptocurrency landscape, and we've seen some absolute phenomenal returns from cryptocurrency where people are turning into, multi-millionaires overnight. And then we've also seen things in particularly America, like the GameStop, and basically, people pumping up the price and turning, a small amount of money into hundreds of thousands of dollars. Generally speaking, that is not normal market behavior, and that skews people's expectation of an investment. So for argument's sake, we'll choose some really simplistic numbers. If you invest $50,000 and you get a rate of return of 10%, that's $5,000. 10% is a decent rate of return. And I don't want to downplay this, but it's only $5,000. Whereas you get somebody that's put, $1,000 in crypto and it's gone to 100,000. I don't even know what the rate of return is on that, but that's 10,000% or something like that. It's absolutely crazy. That's abnormal. That does not really happen.
Yeah. And I think it's the cryptocurrency market and what that's done for investing. And this is sort of going off on a little bit of a tangent, but I seem to think that as a whole, it's helping create a greater awareness around a younger demographic towards investments. However, what you said, Billy, absolutely rings true that, great, people are investing and putting money towards investments, but to go from something like that towards, an equities market that just does not perform in the same way, you really need to align your expectations around what you're investing in. It also rings true for, those that are in pre-retirement or heading into retirement. You naturally would expect that as you're starting to draw down on your investments, you're taking a more conservative approach. And because you're taking a more conservative approach, you expect less volatility and a lower rate of return. So don't expect the, 10, 15, 20, 30% rate of return if you're not prepared to take on the risk that's associated with that investment. If you feel that it's appropriate to invest in an asset that's, volatile and has the ability to, achieve 10,000 or 1,000% rate of return, then that's fine. But be prepared that there is a possibility that in that type of asset, there's going to be huge volatility and you could be experiencing huge losses on the downside of it as well.
Yeah, well said. Probably one of the things as part of the topic that we're talking about is holding your position and maintaining the status quo. And we tend to come across this all the time when we're talking to people. But if you get your investment strategy right and you stick to it and you're prudent and you're disciplined around it, staying the course and maintaining the status quo is often the right decision to make. I've got a smile on my face because it's boring and it's not what people want to hear. There's no magical sauce over the top of it. It's like you stay the path over a long enough period of time. If markets and the economy continues to improve and increase and GDP grows, businesses will get bigger and bigger and better and sell more goods and services, make more profit, return a greater return to shareholders, and everybody wins.
I'm laughing because I had this conversation with a client last night, and I feel like I have this conversation at least once or twice a week, whereby been a client for a couple of years and the recommendation to them is, all by, tweaking a couple of the fund managers and the assets that we're actually investing in. But aside from that, it's continue with your current investment strategy and continue with everything that, we've recommended to them in the past. And the response that I got was, but surely there's something else that we could be doing. Surely there's more. Surely we can, do this or something. Like, come on, there's got to be something. And until you kind of peel it back and look at, okay, this is, rehashing where we're heading towards. This is why we're doing it. And this is the trajectory that we're going on. We don't need to adjust the strategy. And I think that as humans, we're always trying to, it's a good thing. We're trying to better ourselves. We're trying to do more. We're trying to achieve more. But what that can lead to is constantly changing and moving your strategy, which you lose sight of the end goal and what you're trying to achieve. So making sure that you can just have the nerve to stay the course, continue as everything is going. And yeah, it may not be the most exciting thing and it may not, get you as excited as when you first embarked on an investment, but staying the course and really just continuing to do the good things that you've been doing in the past is a lot of the times the most beneficial strategy, albeit not the most exciting.
Really good conduit, Andrew, and a really good layup into probably the last point. And obviously, we're really big advocates of this, and it's having an advisor. And look, I guess not wanting to downplay what we do from a professional perspective, but really, I think there's two things with this. The first thing is fairly, I'd like to say simple and well known, but it's getting access to a range of investment options that you probably wouldn't ordinarily have access to or consider yourself. That's probably a given when people come to us to receive investment advice. But the second one, and this is the most powerful one, and hopefully summarizes up everything nicely that we've been talking about, is it's having somebody by your side to make sure that you're making the right decisions, that you're removing the bad decision-making things that are running through your head to keep you on course and to keep you on track, and somebody who's not emotionally invested in this, because when you're emotionally invested in anything, you make the wrong decisions. So I think from an advisor perspective, it's a very, very understated and probably not well-known benefit that an advisor provides, but that's probably one of the biggest ticket items when we look at the value that an advisor brings when we're talking about an investment strategy and being able to maintain a clear, level head and removing any emotional bias that sits in that decision-making process.
Yeah, it just adds an extra layer of rationality around it. And it really adds an extra layer of being able to just look at, okay, what's the best investment decision, not what's, the right emotional decision, not, all of the other preconceived notions that you may have towards, certain investments. It's just an unbiased person to look at your situation and look at what is the right course of action from here moving forward. So completely agree with you, Billy. And I wouldn't be doing my career and and my industry any service if I did disagree. But yeah, it's definitely underplayed. And I think that everyone comes to us, or not everyone, but most people come to us, for investment advice and investment expertise. And that's part and parcel of what we do. But making sure that you've got someone, on your professional team that can look at things from the outside and not have an emotional connection to what you're doing is definitely a very underplayed aspect of what we do part and parcel every day.
Well said, well summarized. And to our listeners, hopefully you got a fair bit of value about controlling your emotions when investing and some of the things to consider. And yeah, hopefully make better investment decisions based on the information that we've spoken about today. But like always, if there's any information that you want to talk a little bit about in further detail, all of our contact details are in the show notes. As always, Andrew, thanks for your time. Really enjoyed this one.
Always a pleasure jumping on the podcast. And thank you very much to our listeners again for tuning in, and look forward to catching you on the next one.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorised representatives and credit representatives of AMP Financial Planning.